Imagine looking back on 2025, remembering the moment you seized the biggest financial opportunity of your life. When everyone else was running scared, you planted the seeds of your future wealth. Right now, uncertainty clouds the market, and headlines keep screaming about bear markets and corrections. The secret? Bear markets don't destroy wealth for everyone. They quietly make millionaires out of those who recognize the moment for what it really is, the gateway to generational prosperity. So, what if the downturn in 2025 is exactly what you need to change your life? Bear market opportunity, why 2025 could make you rich if you act now, is your playbook for real wealth building. Forget what you've heard about always playing it safe or waiting for the perfect market conditions. Today, as prices drop and fear swells, you're going to learn how markets work, why downturns matter, and exactly how to spot your shot. Let's bust one myth right away. Timing the market perfectly is impossible, even for the pros. But recognizing opportunity? That's a skill you can build, and it begins with understanding how markets move in cycles. Every market has its story, boom, bust, recovery, but the biggest fortunes aren't made during the boom. They're born from decisions made when prices are low, when pessimism rules, and when most investors quit. Looking at decades of data, one pattern emerges again and again. Stocks tend to drop fast, but they climb higher and for longer. Think about this. Bull markets often stretch for years, averaging more than 4 times longer than bear markets, and with much higher net returns. Bear markets, while intense, are typically short, on average about 11 months, whereas bull runs can last over 4 years with price gains dwarfing previous declines. Bear cycles may feel relentless in the moment, but in the big picture, they're the chapter before the next epic recovery. Those who understand how to spot where we are in the cycle and act decisively are consistently the ones who turn downturns into new wealth. That's how market legends are made. Think about this. If you had bought the S&P 500 during the dot-com bust, or scooped up shares in the 2008 financial crash, or even loaded up in the sharp 2020 COVID dip, you'd be sitting on generational returns today. Each of those moments felt terrifying. The news was all red, but after the panic faded, those who acted boldly found themselves sitting pretty, while everyone else watched from the sidelines wishing they'd jumped in. So how do you actually recognize a bear market opportunity and avoid getting crushed by falling knives or false recoveries? It starts with knowing what drives bear markets: fear, forced selling, exaggerated pessimism, and a crucial factor, valuation metrics plummeting below their historical averages. Let's break it down. The most watched valuation metric is the price-to-earnings ratio, or P/E. In bull markets, stocks often trade at lofty multiples, say 18 times or 20 times forward earnings. But in bear markets, panic and pessimism drive P/E ratios down, sometimes into the single digits. That means purely by math, you're paying less for future earnings. And historically, when the market's PE drops well below its average, your odds for strong forward returns skyrocket. In fact, many of the S&P 500's best 5-year stretches started when the market's average PE was below 14. The lower the PE, the stronger the recovery potential. It's not magic, it's history. But there's more to valuation than just P/E. Look at price-to-book ratios, dividend yields, the Shiller CAPE ratio, and free cash flow metrics. When these drop below multi-year norms, it's a sign the market's resetting, and smart buyers begin to circle. One powerful clue? A surge in the equity risk premium, meaning stocks become much more attractive compared to bonds, as investors demand more compensation for taking equity risk. When you see bond yields rising, but stock prices falling, look at the spread. If you're getting paid a lot more for holding stocks, you're probably close to a bottom. While numbers are powerful, mindset matters even more. There's a reason Warren Buffett says to be greedy when others are fearful. The truth is, most investors never see the forest through the trees. They get overwhelmed by negative headlines, panic selling, and endless, "this time it's different" talk. But there's a trick to flip your psychology. When you see record outflows from equities, realize the herd may be selling, and smart money is preparing to buy. Remember, the crowd is usually wrong at inflection points. Let's turn this theory into actionable steps. How do you actually buy during a bear market to maximize your future gains without blowing up your finances or getting sucked into false rebounds? First, don't try to catch the exact bottom. It's time in the market, not perfect timing, that counts. Build a plan to steadily accumulate high-quality assets as prices fall, what pros call dollar cost averaging. Set a schedule. Every week or month, buy a fixed amount regardless of price. This lowers your average cost and keeps your emotions in check. But don't just buy anything. Focus on assets with strong fundamentals and histories of weathering storms. For example, in U.S. equities, index funds tracking the S&P 500 or broad market ETFs offer broad diversification, low fees, and resilience through downturns. For dividend investors, look for aristocrats, companies with decades of uninterrupted dividend growth. When market panic sends their prices tumbling, yields spike, which means better income for you and historically higher future returns. Want to get more tactical? Watch for capitulation. Those fever pitch moments when sellers dump stocks en masse, trees driving intraday volatility and ugly drops. Capitulation marks emotional exhaustion, a classic sign of a bottom forming. Combine this with valuation checks. If the PE on major indices drops below their long-term average, just as you see panic selling, odds are high you're near an inflection point. Let's add a real story. In early 2020, the world was gripped by fears of COVID-19, markets collapsed, and the S&P 500 plunged over 30% in weeks. Headlines howled about the end of the economic world. The most common advice: run, hide, wait. But those who invested steadily throughout the decline, especially at the lows, saw some of the biggest two-year gains in market history. That pattern plays out again and again. Fear spikes, prices fall, sellers flee, but recovery follows, and new wealth is built. What about the bear market of 2022 to 2023? Inflation roared, rates spiked, tech stocks crashed, indexes dropped almost 20%. Many new investors panicked and bailed. Then, as inflation cooled and rates stabilized, markets recovered, led by resilient sectors and top names, especially those with stable earnings, huge cash reserves, and growing dividends. But even if the numbers line up, psychological preparation is crucial. Humans are wired to avoid loss more than seek gain, what psychologists call loss aversion. In bear markets, every loss feels twice as painful as a similar gain feels rewarding. So build habits to manage your emotions before the market swings downward. Write out your plan. What will you buy, under what conditions, and why? Remind yourself that temporary pain is often the price for permanent gain. Let's get even more laser-focused. The wealthiest investors in history, from Buffett to Templeton, didn't make their fortunes during bull markets. They bought when others were panicked, ignored, or pessimistic. The data backs this up. Since 1950, every major bear market was followed by a multi-year bull run. The longer and deeper the downturn, the greater the bounce back. Those who bought at or near the bottom saw returns that outpaced almost every other asset class. Here's another killer stat. Historically, buying when blood is in the streets, when markets are down 30% or more, has produced double-digit annual returns over the following decade. Miss these windows, and you're playing catch-up for years. The key: stay solvent, stay rational, and stay aggressive when everyone else retreats. But here's where it gets even more interesting. Studies of the biggest market crashes show those who invested near the bottom often got staggering gains in the years that followed, sometimes even tripling or quadrupling their money before the rest of the world regained confidence. The pain of steep drops doesn't last, but the recovery, when it comes, is powerful and often swift. The notorious lost decades of the market still rewarded disciplined buyers with outsized returns. So don't just think about surviving the downturn, think about planting seeds when the ground is scorched, because that's where the richest harvest comes from. Courage to act in chaos sets you apart from the crowd and puts you on the right side of market history. Now, what does 2025 look like on the ground? Right now, we see signs of stress, rising interest rates, corporate profits slowing, geopolitical tension creating uncertainty, and markets off their highs. Valuation metrics are compressing. Bond yields offer short-term competition for stocks, driving equity multiples lower. News cycles paint doom and gloom, but look closer. The reset in valuations means future returns will be juicier for those brave enough to buy. So, should you jump in with both feet? Not yet. Prepare, observe, and identify your targets. Start building a watch list of companies and funds that combine strong balance sheets, durable business models, and low debt. Examine their earnings history, payout ratios, and free cash flow. Wait for moments when their valuations dip below their average and have the discipline to buy in tranches. And keep one eye on history. Every time investor sentiment hits rock bottom, recoveries begin. The American Association of Individual Investors Sentiment Survey is one useful tool. When bears outnumber bulls by a wide margin, forward returns spike. Use fear as your compass. When most are afraid, opportunity is greatest. Take diversification seriously. Don't bet the farm on a single company or sector, even if valuations look attractive. Spread your buys across quality assets, mixing growth stocks, dividend payers, value names, and even international funds. Each category has its time, and you want to catch the collective rising tide in the aftermath. Another advanced move? Use tax-advantaged accounts like IRAs or 401ks to accumulate during downturns. Down markets mean lower share prices, so your retirement contributions scoop up more shares, compounding future growth. Many wealthy families turbocharge this approach, buying every month through thick and thin. Here's a personal challenge for you. Set up automatic purchases right now. Pick an index fund, set up recurring buys, and forget the headlines. When markets crash, remind yourself you're getting the best deals in years. When they recover, you'll thank yourself for ignoring the noise. But how do you handle the emotional storm during downturns? Surround yourself with data, not drama. Read market history, study long-term charts, and revisit the playbook of investors who thrived in chaos. Meditation and journaling help anchor your focus, keeping your eyes on strategy, not screens. Let's talk about patience. Bear markets don't end overnight. Recovery takes months, sometimes years. If you buy into a panic, expect volatility. Don't panic if your investments drop further before rebounding. Instead, celebrate lower prices because each new purchase compounds your future returns. And resist the urge to check your portfolio daily. Obsessing over short-term moves is a recipe for anxiety. Instead, set quarterly check-ins to review your allocations, rebalance if needed, and see if your buying plan is on track. Now, here's how to spot signs that a recovery is beginning. Watch for stabilization in key indices, improvements in earnings reports, and positive shifts in economic indicators like GDP growth and unemployment rates. Pay attention to insider buying. When executives snap up company shares, it signals confidence. Also, look at inventory cycles, housing starts, and retail sales. As these rebound, markets tend to follow. Network with other investors, learn from their mistakes, and share ideas. Bear markets forge connections. Everyone's feeling similar pain, but those who swap strategies tend to avoid big errors. Don't forget, the world's greatest fortunes are quietly built when uncertainty reigns. Look past today's headlines to tomorrow's opportunity. So here's your call to action. Are you waiting for perfect clarity, or will you seize the moment others fear? 2025 could be remembered as the year fortunes were built. If you understand how bear markets work and act with wisdom and courage, start observing, planning, and buying with intention. Every share you scoop up during the storm could be the foundation of your future legacy. Ask yourself, in 5 years, will you regret being cautious, or will you thank yourself for acting when others ran? The difference comes down to education, discipline, and courage. Bear markets test your resolve, but they also reveal your true wealth-building potential. Get ready, because opportunity disguised as fear is knocking. Bear markets don't last forever, but the results of smart moves during them can. And if you want to remember 2025 as your turning point, the time you chose action over fear, then get moving now. The road to wealth is paved with risk, resilience, and relentless learning. But the journey starts today, even while others hesitate. Because history doesn't just repeat, it rewards those who pay attention.